Most every entity receives the revenue that supports its operations in one cycle during a year, but the expenditures do not necessarily match that cycle of available revenues. So there's a mismatch. We have a lot of expenditure requirements early in the fiscal year. We don't necessarily get the revenues in. And we had a sufficient balance in the state treasury that we could handle those mismatches without external help. Our deposits in the state treasury have been winnowed down over the last several years to the point that we just don't have available cash in the bank to make our obligations timely. So we used Wall Street to make a temporary loan, and we make those payments, and the vendors are none the wiser. We pay the RANs off, and we're back to normal. Thank you all for coming this morning. My name is Ron Henson. I'm State Treasurer. I've asked you to come this morning because we have a bit of good news to share with the citizens of the state, something that we don't always get to express on a regular basis. I've asked the Speaker of the House, Taylor Barrada, to join us, and Commissioner Jay Darden. President Alario was going to be here, but unfortunately had to go back to the district, so John will not be joining us. So the reason we've invited you here is to tell you that the state is in a position to repay a short-term borrowing that we took out late last calendar year in order for us to get through a cash flow impediment, if you will. Our office, in conjunction with Jay's staff, on a daily basis monitor how much cash we actually have in the state general fund and in the treasury. That amount of funds varies on a day-to-day basis. In the first part of a calendar year, we have very little revenue coming in, and then as the year moves on, I should say the fiscal year, as the fiscal year moves on, the revenues begin to come in and the expenditures level out. So we have a cash imbalance. Usually, however, up until the last few years, we've had sufficient funds in the Treasury to adequately cover those shortfalls and then timely repay them by June the 13th. Last year, we ended the fiscal year with $300 million still being owed to the borrowed funds, and we had to take care of that during this fiscal year. So we put together a team, and it's quite a long list of participants. I'll give you those individual names or departments and agencies, entities that participated in it if you would like them. But we came up with a cash flow model that depicted inflows and outflows to the general fund and the Treasury over our fiscal year period. We identified, obviously, that there was going to be a point in time that we were going to be dangerously close to not having sufficient cash in the Treasury to pay our obligations. We did not want to get to that point without having something in place to mitigate that possibility. So we employed a process known as revenue anticipation notes. We have done that as a state in the past. Many states across the United States employ this on an annual basis. We haven't had to do it since the late 80s, I believe. We sized, of course, we didn't want to borrow too much money because there's a cost to purchasing capital. We sized the amount, and then we made that loan. We had 6 banks. We did it with an RFP. 6 banks responded. We chose U.S. Bank and J.P. Morgan Chase because they were the least expensive, and we chose 2 banks as opposed to 1 because neither wanted to cover the entire $400 million. So we were authorizing the borrowing of $400 million. And over a period of time, we drew down in 3 tranches $370 million. Now, our plan all along, in our structure that we shared with the bankers, our plan all along was to repay it before the end of July. And this is a result of our planning. We had good, strong cash intake in April. We anticipate that we'll have another good month in May. So we're going to pay off our first payment established in the schedule is not due until June the 1st. But we're going to pay it on May the 1st. And by doing so, we'll save $100,000, a little over $100,000 in interest earnings. And then we are going to pay the July and August payments early. We're going to do that in June the 1st, and we'll save a little over $200,000 by making that payment early. Now, this is not going to be new money that comes into the Treasury. This is money that does not have to be expended from the Treasury and can be used to shore up the appropriations that are already in existence. And I'll let the Speaker and Commissioner speak to those issues. So why are we doing this, and why are we proud of it? Well, number one, you realize just a month or so ago, one of the rating agencies, the third rating agencies, downgraded the state because of our poor fiscal performance. Well, this sends a message that the state of Louisiana may have cash flow issues, but we have a plan in place to deal with those cash flow issues, and we can put it in place, implement it, and pay it back as promised, but early. And by paying it back early, we actually realize some savings for the state of Louisiana, and takes a little pressure off the budget side of the equation. Now, it's kind of like a child going to kindergarten and they get a gold star for doing something really good that day. Does that mean they're going to get an A and automatically advance to the first grade? No. We've got a lot of work to do to get to that point. But it is a good sign. It is a good indication of what the fiscal managers are doing in the state. And trust me, Treasury did not do this alone. We worked very closely with the commissioner and the leadership in the legislature to make this happen, as well as many individuals in other entities, including our state financial advisor. But it is good news. We're going to save $330,000 this fiscal year, and it's something that Louisiana should be proud of.
Just real quick, first, my gratitude to the Treasurer's Office, and of course, with the transition in the Treasurer's Office recently, even more gratitude to the diligent work that's been done, regardless of whether the budget increases or decreases. The Treasurer's Office manages that 12 months of appropriation, and as he explained, the plan of what comes into the general fund and what goes out of the general fund is what keeps our checking account in balance. And I was joking with him earlier that as a banker, I'm usually disappointed when people pay off their debt early. When I'm on the other side of the fence, this is great news when you pay your debt off early and save $300,000 in interest. So good sign for Louisiana. It is difficult, and in my banking role, we deal with local governments that struggle with revenue anticipation as well, that depending on their fiscal year, money comes in at various times. If you're in local government, all your ad valorem comes in January, and you wait for those days to come around. So it's a common practice because of the imbalance in the way cash is received by governmental entities. So when you can pay it off early and have these kinds of savings, it's a compliment to a lot of diligent work. I will ask that we hopefully, as we go forward and stabilize our budget situation, that these revenue anticipation notes, knowing that they're available, that you don't have to do it very regularly, and it's been quite some time since the state has done it in the past. So I'm glad for this day and glad that we have the opportunity to take advantage of the savings in paying these off at an earlier than anticipated date.
As you can see, we're hungry for any bit of good news, and this is good news. Even though in the big scheme of things, it's not a huge amount relative to our budget situation, but a $300,000+ savings is great news for the state, and it's symbolic in showing our fiscal responsibility to those who are watching us from afar, particularly those on Wall Street who look at our every move. And and this is a very positive move, and I want to thank Ron and his staff, many of whom are here, for their hard work. We've got a great working relationship, and they did a lot of the heavy lifting, and our staff was involved as well. And this goes back, as you recall, to our discussions over the course of the past year and a half or so, that when we spend down and eliminate all of our fund balances, we take away the state's capital in order to fund inter-fund borrowing, which is usually the way that we're able to manage cash flow. And we just weren't able to do it because there were no fund balances, and this was a tool available to us that we utilized, and we utilized it in a fiscally responsible way. So I appreciate Ron and his staff's effort to let us save a little bit of money.
One additional point, Jay alluded to it, and the speaker as well. To date, in the Bond Commission, we have approved 36 similar budgetary loans for local government, and the total of those loans is close to $200 million. I believe that's correct. So this is a common tool that is used throughout government, and it works well when you get the money to repay it and do so on time. So we're excited about that.
While this is not a major savings or solution for our fiscal issues in the state, it is a good thing that we're doing. The Wall Street people and the rating agencies will notice what we've done and that we've paid it back early, and that will be a very good mark for the state. And hopefully when we deal with our revenues and expenditures, they'll take this into consideration, and we can start discussing rating upgrades instead of being downgraded.